Good morning, everybody. This is Nasira from my beautiful home office here. I hope you are all doing well. I hope that, from yesterday's broadcast, you were able to wake up today and make your bed, because that's the first part of starting a successful day. Now, I do have a very special guest for us today, and we're going to be taking this broadcast from a good news perspective. So I want to welcome Barry Dowling from Dowling Financial Services. He is an amazing guy, and let's bring Barry on so you can see. Hi, Barry.
Good morning. How
How
are
you?
I'm well. How are you doing?
I'm very good, thank you. So
Good.
I wanted to talk to you this morning. I know you and I have a long-standing relationship in terms of my financial portfolio, but I wanted to talk to you today about your perspective on what's going on. And I know we talked earlier in terms of, what's the good news in all of this?
Well, I think we're facing an opportunity that a lot of people aren't appreciating. The markets started to slide around mid-February. And what we've seen the last 2 months, we went down into what's known as a bear territory, which is 20% or minus 20% or more in a decline. So the market's probably hit the bottom at around 30% and then started to come back a little bit. And people have probably heard it before, but we're in the only business when we have a sale and people run the other way. So we're looking at about a 20% discount on a lot of purchases out there right now. So one of the opportunities is to have a look at what you've been doing investing wise, what your asset classes have been, and making sure your balance is still there between fixed income and equities. Equities are going to come back a lot quicker this time than the fixed incomes, just because the interest rates have been beat up so much. And then to look at that you're in the right vehicles that are going to recover quickly. If you were set up for long-term investments to start with, you probably haven't taken that full brunt of the market decline. And I think right now we're probably at the bottom of the market as well, and that we're looking at pretty much bouncing around on the bottom right now, and some kind of recovery within the next probably 4 to 8 weeks.
Right. So when people that have, investments and things, and they're going into this panic mode, what would you say to them at this point?
Well, initially, don't do anything. There's several stages of this emotionally, and what you don't want to do is react on emotion. Warren Buffett said, "Be greedy when others are fearful, and fearful when others are greedy." So if you see everybody selling off, you probably want to buy something because it's contrarian to what the markets are doing. The stock markets themselves are a secondary market. So every time a stock is sold, somebody has to buy it. It's not like a mutual fund where you just liquidate your share and you get your cash out. So it's like a house. You can't just sell you can't just disintegrate your house and take the cash for it. You have to find somebody to buy it.
Right.
So I guess the idea is that if people are selling off and you're getting a 20% discount on what they're selling, you want to hope that if you're a stock person, that you're picking the good value stocks that are going to have the growth going forward, or if you're in mutual funds, that you have a manager that's doing that for you. One of the reasons that I promote mutual funds over individual stock trading, you just get more coverage with less amount of money. Basically, you get a broader portfolio, and you get professional management as well.
Right. So in terms of, like you said, don't do anything in terms of the emotional side of things, right? But if, let's say, somebody was in a position where maybe in the next little bit they were coming up to retirement, and, this is something that they were counting on, what is sort of your professional opinion for those people that are looking at from the retirement perspective?
Okay. And just to back up, when I say don't do anything, that's don't do anything initially.
Initially, yes,
Yeah.
yes.
Approach it logically and calm and get the emotions out of it. If you're coming up to retirement, hopefully most people get the plan for the retirement. Sometimes there's an unexpected layoff or restructuring or something, and you're forced into it a little early. But if you're planning for retirement and you've properly set up your portfolio, you won't have been hit as hard, again, with some downside protection. You won't be hit as hard in these down markets. And what you really want to do is have a look, make sure your fixed income is into something that is going to recover quickly. When I talk about fixed income, I'm talking about any kind of debt instrument, be it a bond, floating rate, and there's many, many different kinds of bonds that you can be in as well, and they all react differently too. So you want to make sure your bond, your fixed income is in the right kind of bonds that are going to recover the quickest in a low interest rate environment. And then you want to make sure you still have some equities as well, probably some more larger blue chip and dividend paying investments that are going to take care of themselves in these downtimes too, with reinvestments.
Right. And for those who do have to take money out for, just because a lot of people could be laid off, or there could be a decline in their income and they have to sort of tap in, is there a sort of a formula that you would use for maybe if you did need to take money out?
Well, again, everyone's individual. It depends on their tax situation. So yeah, we usually look at if they've already made some high income this year and we're expecting to be back in work maybe July, August, we may want to look at taking things that aren't going to affect the tax base as large. So maybe leaving the RSPs alone for now, looking at tax-free savings accounts. Perhaps they have some non-registered, just open investments lying around that we can utilize as well. So it's really an individual approach that way. And the government has taken, with retirement income funds and life income funds, they have taken the steps to allow a 25% reduction in the minimum amount you have to take.
Okay.
So the amounts, if you're already collecting a RIF or a LIF, retirement income fund or life income fund, there are minimums based on percentage and January 1st values. So the government has said, the federal government has said, you can take 25% less this year if that works. For some people, they need the full income and they're taking more than the minimum anyways. But I know I do have clients that take it out because they have to.
Right.
So this year they'll be taking out the 25% less for sure.
Right. And so for those people, and myself included, and I know we have had a chat about this, but you know how some of us are doing monthly contributions, right?
Yes.
In terms of our investments and how we're sort of, either it's RSPs or the TFSA, wherever. Do you suggest like that, people, if the ability is still there, to continue with that?
Absolutely. There's a strategy called dollar cost averaging, where you basically pick a time and put in that time the same amount regularly. So in most cases, it's monthly. So you might pick the 15th of the month and you stick your $200 in every 15th, and it goes into a predetermined allocation within your portfolio. And that way you're taking advantage of 12 different prices over the year rather than picking one day and getting that day's price. So in a market like this, where we've gone down, if you're buying in January when the market was high, if you bought for $15 a unit and you put $200 in, well, $10 a unit, you put $200 and you bought 20 units, right? So now if it's down to $5 in an extreme example, you're going to pick up the 40 units.
Right.
So you've picked up more units, and all the price has to do is recover, and you're going to have made money. Right. So that's buying at a lower cost base.
Right. Is there anything that you can sort of suggest for people? Like, is there any kind of, I know you've talked about a bit of the government side of things, but is there anything that you know of that could help people at this point if they're struggling, or if they don't know what to do? Like, what is it? I know there's no magic answer. And I also want to ask you another question about data. So let's see if you can answer this one first before I go to the data question.
Okay. Well, I encourage everyone to work with a professional. The advantages become so apparent in these kinds of markets. There's a few reasons for the quick decline in this environment. There's margin calls on big investment institutions and pensions, that kind of thing. But one of them is the passive ETFs and robo-advisors that have set up people basically answer your 8 questions and you're doing it yourself and you're saving all these fees and everything, which is fantastic. But at a time like this, the emotions kick in, people panic and people sell. As long as you haven't sold anything, you haven't taken a loss. There's a loss on paper, there's no question. So your investment value looks down. But getting back to what I said about the units and the dollar cost averaging, if you have 100 units that are worth $10, it's $1,000, whatever. And then if you have 100 units and they go down to $8 worth 800, but you still have 100 units.
Right.
The minute you sell and you're down to 50 units, you've taken a loss. That's crystallizing your loss. So as long as you haven't crystallized any losses, you still have a chance for decent recovery. And I don't know if I really answered your question, did I?
No, you did. Because
Okay.
I think sometimes, people may not understand, even if they're managing it themselves, and a lot of people do, right? And sometimes they just have it with their bank, but yet they don't really understand where their funds are. Like they kind of just
I guess that's part of what I do, and that's kind of what I was alluding to is I'm going to help you remove the emotion, or any professional is going to help you remove the emotion, take a logical look at it, and a longer term. Because people tend to focus on the moment. 2008, we went through a huge recession, big correction, and clients that I had in 2008, they barely remember it now. It's a distant memory, and this will be the same thing. In five years, people will remember the health consequences, but they're not going to remember the financial as much.
Right. And I think that's where I was going to come back to my next question, is about the data. So as you look at past incidences where we have seen these either recession or SARS, if there was any kind of impact, or any of the major things that have happened, do you use that, or is that what's used sort of to typically say, well, we should see a recovery in the next quarter, or like, are you using those numbers as a gauge?
Yeah, most of what we do is based on historical experience, and a lot of people have compared this to 2008. I think it's more like 2001 with the 9/11, because the markets we had a great year last year. I think, my entire book was in double digits for returns, and we were approaching that this year in January, with things were flying. As I said, February 19th, we started the slide, and I think I've lost my train.
I think we're talking about 2001, right?
Yeah. So in 2008, the system was broken. The financial system was broken. So in 2001, it was an outside event. So as I say, this year we're flying along, and then an outside event is what hit us. There's nothing wrong with the markets. Numbers were good. Price earning ratios were good. Interest rates were still low. Consumers were buying. Household debt starting to climb, but not totally out of control. So we were going along great. Outside event hits us, and basically the world shut the economy down. Now, one thing to remember is the markets are always ahead of the economy. So we started the slide February 19th. The economy is just starting to really feel the pinch now. So what is that? 8 weeks later, more or less. So, which is pretty quick. It's usually 3 to 6 months. So 2 months, the economy has felt the pinch. So when the economy starts to recover, you can bet that the markets have already recovered again 3 to 6 months earlier. So as the markets are recovering, we're still going to get plastered with all the bad news. It's the end of the world, and your money's useless, and there's nothing to buy out there, and we're all going to be broke. And then all of a sudden the economy recovers, and that's when these individual investors that have sold out and crystallized their losses are going to go, wow, it's time to get back in because the economy is doing great. Well, they've missed the market by at least 3 months. So they've missed some of the most important growth period in there, because the recovery is like a bounce. So it goes down and then it'll skid along the bottom, and then it'll bounce back up severely, and then the growth will start to calm down. And that's what'll happen is people are going to sell low and buy high because they're doing it all based on emotion. And again, that brings me back to working with a professional in anything. I mean, don't do your own taxes, don't sell your own house, and don't try and do your own investments.
Right. And I think this is probably one time in history where that's becoming so crystal clear. Is, we're not going to obviously perform our own heart surgeries and, these kinds of things. And I know these analogies are used all the time, but really now when we are in this position where we don't know what's going on, and, there are professionals who can be there like yourself, it's good to have that as your backbone, because really when we don't know what we don't know, we need the advice of those that are following the certain trends and markets and guiding us. So I think you're right in terms of having a professional, no matter what area, you're looking at getting some clarification in this. I find that the people that I'm talking to, like obviously as a realtor, the finances are all tied in, right? And and it's just about supporting people through this. It's not about buying, it's not about selling, it's not about really, doing the sale part of it. It's really about managing the emotions for people wherever they are on that spectrum, right?
That's right. And ultimately it's the client's decision. Right. But I think what we're here to do as professionals is to guide them, educate them, and explain the differences, the pros and cons, and make sure they're making an informed decision.
Right. And so I know I've got your website sort of scrolling on the bottom. Is it okay for me to share your phone number in case somebody has questions or wants to reach out because they don't really know what to do? Is it okay for them to reach out to you?
Absolutely. You can share that's my office line. I'm not there right now because I'm working from home, being a good citizen. But leave a message, and my website's there as well. You can contact me through the website as well.
Perfect. You know what? This has been I think for all of us, it's a good conversation to have and not a panic conversation, right? Where everybody's kind of, flying off their chairs. But I think the important thing is to keep the conversation going, because day to day, right? Like in terms of whatever the news and the media is putting on, of course, probably will have some effect. But the thing is to keep this conversation going. And if there are questions, to reach out to whoever is in your circle that's a professional that you feel comfortable with. I think that's probably the best thing we can do for everybody.
Yeah, agreed. I just want to point out, when you're walking up a set of stairs, don't look at each step. Look at the top of the stairs, because that's your financial journey, right?
Right.
Day to day is going to be volatile, and you're going to get hammered with bad news because that's what sells. But if you're investing properly, long term, you're going to be okay.
Well, thank you. And I think that's what I wanted. The message is, everything is going to be okay if we just keep that perspective that, we're all going to get through this. We are going to get through it. We just don't sort of have a clear timeline, but we're in this together. We're going to get through this together. And the whole idea is to support each other through the journey, right?
Exactly.
So for me, you've been a godsend.
Thank you.
It's nice to know I can pick up the phone and talk to you. And I appreciate you taking the time and coming and speaking to our viewers here to just shed the light on finances.
Absolutely. And on the website, on my website, there's tons of articles archived that, make a difference in a time like this, just to get some perspective and have a look. So people, please feel free to go on, no obligation, just read a few articles, and I'm sure there's something there for everyone.
Excellent. Thank you. Is there any more parting words that you want to share with us before end the episode.
I'd like to thank all the healthcare workers and the food suppliers and everybody else that are out there on the front lines for us. As well, the governments, provincially and federally, I think have stepped up. Doesn't matter what political colors you are. I think they've all done a good job. They've taken the lessons that we learned in 2008 and they've implemented them quickly. For a government to get money from their coffers to the street within 6 weeks is phenomenal.
Yeah.
And salutes to all the private institutions that have stepped up and filled that gap until the money could get down. And I think with the steps that have been taken, I'm sure we're going to be paying for it for a few years, but it's going to make life easier for a lot of people. And I think it's going to aid in the recovery as well.
Yeah, and I think that's the remedy right now we have to deal with now. And I think that, like you said, the government has done an amazing job in getting it from their side to really people on the street. So thanks to all of them. Today, let's do hashtag frontline workers and hashtag Canada. So I appreciate your time. I will hopefully see you soon in real life, although for now we're doing this. But
I look forward to sharing a tea with you.
Yes, absolutely. Thank you again. Have a great week. I'll talk to you soon.
Thank you. Have a good week.
Thank you, everybody, for joining. I really appreciate it. I hope this information was helpful to you. If you need any further information, you can always get in touch with us. And I'll see you tomorrow. Take care.